Massive day for the unemployed, because the AI bubble collapse has just begun, and Meerkat is not predicting that. Meerkat is reporting it. It started this morning while you were still asleep, which to be fair only narrows it down to before noon. In the space of a few trading hours, over $1 trillion was wiped off American stocks, and more than half of that damage came from just 6 companies, the 6 that were supposed to be the safest bets in the entire boom. SpaceX, the biggest stock listing in history, has now erased more than $1.2 trillion of value, falling 13 of the last 16 sessions. Korea's stock market dropped so fast the exchange had to activate an emergency brake and freeze the sell orders. And the most famous stock picker on television is now telling anyone holding data center stocks on borrowed money to sell at the opening bell and never look back. The most crowded, most celebrated, most borrowed against trade in the history of markets has cracked straight down the middle, and it cracked for the most humiliating reason imaginable. Meerkat will show you exactly what snapped, why it cannot be unsnapped, and what falls next. And don't say Meerkat didn't warn you. Let Meerkat explain. Consider this an emergency update. Normally there is a gentle bit here, some small news from Meerkat's cozy little life before the finance begins. Cancelled. This video was not on this week's schedule. Meerkat was halfway through writing an entirely different one when the alert started arriving, and by the 4th alert he had binned the draft, wheeled the whiteboard back out, and started typing with shaking paws. There was no time to brew properly, so Meerkat has made tea using hot water from the tap. From the tap. He is aware that is a crime. That is the severity level we are operating at. You get 3 parts, delivered at speed. Part 1, the bloodbath, what actually happened. Part 2, the 2 knives, because this crash has 2 blades and everyone on television is only talking about one of them. And Part 3, the unwind, what breaks next and how you watch it happen from the couch, which is fine, the couch is where you were going to be anyway. Part 1, the bloodbath. Start with the number, more than $1 trillion, gone from American stocks in a matter of hours. To picture a trillion, imagine $1 million and then imagine it 1,000,000 times, and then imagine none of it belongs to you, which for once requires no imagination at all. Now here is the detail that makes this sell-off different from every wobble that came before it. Roughly $500 billion of that damage, $541 billion, came out of just 6 companies, and they were not the meme stocks, they were not the frothy little startups. They were the memory chip makers, the most profitable, most celebrated, most institutionally owned trade of the entire AI era. Nvidia down almost 5%, roughly $300 billion vaporized in a session. SK Hynix down over 9%, $95 billion gone. Micron down about 5%, $82 billion. Western Digital and Seagate, another $38 billion between them. And then SanDisk, SanDisk, down double digits on the day, and now down 47% from its June record. Its shares have collapsed from over $2,300 to under $1,300 in a single month. That is $170 billion of market value deleted from one company in 4 weeks. A month ago, SanDisk was the poster child of the boom. Today, it is the chalk outline. And towering over all of it, SpaceX. When SpaceX listed on the stock market, it was the largest debut in financial history, hailed as the crowning moment of the entire era. Since then, it has fallen in 13 of the last 16 trading sessions, from a peak of 225 down to around 113. That is more than $1.2 trillion of market value, erased. To give that a shape, SpaceX has now lost the equivalent of one entire Tesla. A whole Tesla, the company, not the car, deleted from the scoreboard in a matter of weeks, from a single stock, while the television kept saying the word resilient. When the flagship of the boom loses a Tesla, and the response is a shrug, the shrug is the story. Nobody shrugs at $1.2 trillion in a healthy market. They shrug when they have already accepted it. And understand why memory matters, because this is the load-bearing wall of the whole story. Every AI chip on Earth is useless without memory chips bolted to it. Memory is where the thinking lives, and for the past year, memory was the one part of the AI trade you could touch. Data center returns were a promise, but memory prices were a fact, up triple digits, because the AI build-out was devouring every chip on the planet. Memory scarcity was the proof the boom was real. You even paid for it personally when your laptop got mysteriously more expensive this year. That was the memory shortage reaching into your pocket, or technically your mom's pocket. Let us keep the records accurate. And the panic is not contained to Wall Street. In Seoul, the Kospi index plunged 8% so violently that the exchange triggered a mechanism with the adorable name of a sell sidecar, a cheeky little handbrake that freezes program selling because humans were dumping faster than the system could process. Understand what Korea is in this story. Korea is the memory workshop of the world, home of SK Hynix and Samsung, and the boom reached all the way down into ordinary life there. Reports describe chip company employees taking out loans to buy houses on the strength of AI bonuses, actual housing inflation, in actual neighborhoods, funded by the expectation that the memory shortage lasts forever. That is what the top of a bubble looks like, not charts, mortgages. Quick pause, because you are about to ask why any of this concerns you, a person whose entire portfolio is a loyalty card and a drawer of cables. It concerns you because there is no such thing as not owning this trade anymore. The AI complex is now the spine of every index fund, every pension, every sensible boring retirement product in the Western world. The 6 companies that just lost $500 billion are stuffed inside the fund your household relies on, the one managed by people who described it as diversified. When this trade unwinds, it does not unwind at the rich, it unwinds at everyone, through the pension, through the index, through the job market you are allegedly about to enter any day now. So yes, sit up. You can stay horizontal, but sit up internally. So when the scarcity trade, the proof itself, loses $500 billion in an afternoon, that is not profit-taking. That is the market discovering the proof has a problem, and the problem arrived on Monday morning, from Shanghai, wearing 2 knives. Part 2. The 2 knives. Knife number 1. China just broke the scarcity. On Monday, a Chinese memory maker called Changshin Memory Technologies (CXMT) went public in Shanghai and promptly rose a cheeky 466% on its first day of trading, briefly becoming the most valuable listed company in China at a valuation around $487 billion. This is the 4th largest maker of DRAM memory on Earth, and it has been feasting, because while the Western giants redirected their factories toward premium AI memory, CXMT cheerfully hoovered up the ordinary memory market they left behind. And there are even reports that Apple is testing CXMT chips for devices sold in China. The demand side of the memory squeeze just met a very large new supplier with a very large new war chest. But the IPO was the small news. Here is the big news, the one that actually detonated the sector. The same day, it was reported that a state-backed Chinese firm has begun mass-producing its own DUV lithography machines. Meerkat will translate, because this is the single most important sentence of the week. Lithography is the step where a machine projects the circuit pattern onto the silicon, like a projector drawing the chip into existence. It is widely considered the hardest bottleneck in all of chipmaking, so hard that for years essentially one company on the planet, ASML in the Netherlands, could do it at the advanced level, and for years the West treated that bottleneck as a weapon. Since 2019, export controls have banned China from buying the most advanced lithography machines outright, the whole point being to freeze Chinese chipmaking several years behind the frontier, permanently. China's response was to stockpile the older generation of machines, the DUV tools, before the walls went up, and then squeeze them with clever brute force techniques to produce chips far closer to the frontier than anyone planned for. Slower, more expensive, lower yield, but working. The entire Western strategy for containing China's chip industry, the export bans, the restrictions, the whole apparatus, rested on one final assumption. Fine, China can use the machines it hoarded, but China cannot build these machines. That was the moat, that was the wall. On Monday, the wall reported that it is now being manufactured in Shanghai, roughly 5 machines this year, 20 next year, headed to China's biggest chip makers. And in a detail so perfectly timed it belongs in a museum, the American Congress is currently advancing a cheeky new law to block China from buying the very machines China just started building itself, banning the export of a product to a country that now manufactures the product. Tremendous work, everyone. World class. The market read the implication in about 4 minutes. ASML fell 7% to its lowest level since June. The companies that make the other chip-making tools fell 5 to 7% in sympathy. AMD dropped over 7%. Because if China can build the machines, China can build the factories. If China can build the factories, China can flood the market with memory. And if China floods the market with memory, then every single valuation in the scarcity trade, every memory stock priced for a decade of shortage, is wrong. Not slightly wrong, wrong at the foundation. The AI trade was a bet that computing power would stay scarce and expensive. China just placed the opposite bet, in public, with machines. Now one cheeky caveat, because Meerkat stays honest even mid-collapse. CXMT cannot yet make the most advanced AI-grade memory, the premium stuff, because that still requires the one machine China has not cracked. The DUV route is slower and clumsier than the frontier tools. So the immediate damage lands on ordinary memory prices, not the top shelf. The analysts are technically correct about that. But markets do not trade the present, they trade the story, and the story just changed from China is contained to China is coming. When your entire valuation rests on a shortage lasting 10 years, you do not get to relax because the flood is arriving in 3. Morgan Stanley is already warning that memory prices peak late this year. The shortage has an expiry date now, and everyone just watched it get stamped. Knife number 2. The demand was borrowed. Because while China was attacking the supply side of the story, the market finally read the fine print on the demand side, and the fine print is unbelievable. The same week as the Shanghai debut, headlines landed about a fresh round of Nvidia deals, potentially worth $750 billion, that revived the ugliest phrase in this entire saga: circular financing. Let Meerkat explain what that means, slowly, because once you see it you cannot unsee it. Nvidia is reportedly in talks to guarantee as much as $250 billion of financing so that OpenAI can lease computing power from a $500 billion data center project. Follow the money in a circle. The chipmaker guarantees the loans so the AI company can rent the data center so the data center can buy the chips from the chipmaker who guaranteed the loans. The seller is financing the buyer and the whole loop gets reported as demand. It is a bakery lending you money to buy its bread and then announcing to the village that bread demand has never been stronger. And this is not one deal, it is the operating system of the entire boom. The chipmaker has reportedly built financing arrangements across its whole ecosystem: the AI labs, the rent-a-cloud companies, the startups, a family tree of borrowers whose allowance comes from the company they spend it with. Money doing laps of the same track and getting counted as fresh demand on every lap. And the beautiful tell, is what happened to big numbers. A year ago, a giant announcing a $500 billion partnership would have sent everything vertical, no questions asked. This week, when a cheeky $500 billion of letters of intent landed between the chip world and Korea, the professional reporters covering it admitted, on air, that they could not actually say what the number contained. Spending on data centers? Chips? Investments in future chips? Nobody knew. All of the above, said the executives, smiling. When markets celebrated big numbers, that was the boom. When markets started asking what is actually in the number, that was the top. And the professionals have started saying it out loud, which is the part that should chill you. The most famous market voice on television spent this week comparing the whole arrangement to the dot-com era, saying he lived through 2000 and does not want the sequel, and telling viewers flatly that anyone holding data center stocks on borrowed money should sell at 9:30 tomorrow morning, and that they will not regret it. Meanwhile, respected investors are asking the question nobody dared ask a year ago. What happens to the chipmakers' fabled growth if the big spenders ever cut back? Because the arithmetic there is naked. The flagship chipmakers' growth exists almost entirely because a handful of giants keep buying, so if the giants trim the spending, the growth does not slow, it evaporates. The honest answer, delivered on morning television by the man made famous for shorting 2008, is that the market on that news goes straight down. His words, straight down. And notice the shape of the counter-argument he received, that the fact people are asking means we are not at the top. That is where the bull case now lives, not in profits, in the observation that people are still nervous, which is apparently bullish. Meerkat has read a lot of financial history, and that particular argument appears in all of it, always in the final chapter. Even the optimist's defense has become an accidental confession. Their argument is that the spending will continue because the bond market is still willing to lend. Sit with that. The bull case for the biggest trade on earth is no longer that it makes money. It is that the borrowing is still available. The hyperscalers are reportedly running out of free cash flow, some already negative, funding the build-out with debt, and the Federal Reserve meets on Wednesday with markets genuinely split on whether a cheeky rate hike is coming, with a war pushing oil prices around underneath it. An empire built on cheap borrowing, heading into a week where borrowing might get more expensive. What could possibly? So put the two knives together because this is the whole video in one paragraph. The AI trade needed exactly two things to be true: scarcity, forever, on the supply side, and real demand, actually paid for, on the other. On Monday morning, China put a knife in the scarcity. On Monday afternoon, the market looked at the demand and found the buyer's money was the seller's money wearing a hat. That is why this is not a dip. Every previous sell-off attacked the price of the story. This one attacked the plot. Part 3. The unwind. Now for the conviction, and Meerkat is not going to hedge this into soup. Bubbles do not end because one day goes red. They end when the story dies, and this week the story died. Not the technology, the story. The one that said computing stays scarce, prices stay high, the spending is real, and the debt never comes due. Every leg of that story took damage in the same 48 hours, and that is why the selling behaved differently this time, why the exchange in Korea had to freeze it, why an 8% plunge in Seoul needed an emergency brake, why the biggest IPO in history is falling most days it opens. The smart money is not debating anymore, it is leaving, and it is leaving through a door it is holding open for you to walk in. And underneath the dominoes, a slower, colder current. The rest of the world is not waiting around to find out how the American AI trade ends. Europe is actively swapping out flagship American tech providers for homegrown ones, with French intelligence reportedly moving a decade-old contract from a famous Silicon Valley firm to a local company, part of a broader continental push to stop outsourcing critical systems to America entirely. The best customers are not just nervous, they are redecorating. When your biggest clients start building their own version of you, the growth story has a leak in it that no earnings call can patch. Here is roughly how the dominoes stand. Memory prices roll over first because supply is coming and everyone now knows the date. The scarcity premium drains out of every chip stock because the premium was the shortage. The borrowed money build-out then meets a lending market that has stopped being generous at the exact moment the Federal Reserve is deciding whether money gets dearer. And then comes the sentence. Some chief executive on some earnings call announces they are slowing the build-out, the market cheers the discipline, and every other executive on Earth receives permission to quit at the same time. That is how the trillion-dollar spending race ends, not with a bang. With applause for the first deserter. And if you think the giants would never blink, remember that they are no longer spending their own money. The build-out runs on bonds now, and bondholders do not dream. Bondholders read covenants in bed. The moment the lenders want a higher price for the money, the visionaries discover discipline with remarkable speed, and discipline in this market is the pin. While that plays out, 3 things to watch. From the couch, your natural habitat, and, let us be honest, your legal address. 1. Watch SanDisk's earnings on August 5th. The company at the center of the crash reports first, and its forecast for memory prices is now the most important weather report in world markets. 2. Watch the Fed on Wednesday. This entire edifice runs on borrowed money, so the price of borrowing is the price of the bubble's oxygen. And 3. Watch for the rallies, because they are coming. There will be enormous green days. Headlines will declare the bottom is in, the dip was a gift, the crisis is over. That is what every collapse in history has looked like from the inside, a staircase down with a cheeky rally on every landing, each one designed to pull the last hopeful money in before the next leg lower. Do not be the last hopeful money. The people selling to you this week have names like pension fund and sovereign wealth. When they are the ones leaving, you are not early, you are the exit. And so we arrive, as we always do, at you. The great irony of today is that the safest person in world markets right now is the one with nothing in them. No margin loan, no data center stocks, no leveraged bet on scarcity. You cannot be margin called on a beanbag. Trillions of dollars of the smartest money alive is currently trapped in a burning theater arguing about which exit is fastest, and you are outside on the pavement at midday in pajamas, financially untouchable. Somewhere right now, a fund manager with 3 houses is having the worst week of his life, and you, a person who owns 1 fork, are completely fine. The market has finally produced a game you cannot lose by locking you out of the casino at birth, not because you were wise. Because you were broke. History will not know the difference, and Meerkat suggests you never clarify. Meerkat is not telling you to buy anything, sell anything, or short anything, and if you are trading any of this with borrowed money, Meerkat is not telling you anything at all. He is lighting a candle for you. Meerkat is not a financial advisor. Meerkat is a small animal with a whiteboard, a phone that will not stop screaming, and a mug of cold tea he has decided to call iced tea for morale. Please do not sue Meerkat. Like, subscribe, and go tell the household you live off that you predicted all of this. They will not believe you. They have met you.